So British investors, I have some bad news. On October the 17th, the Chancellor of the Exchequer, Jeremy Hunt, unveiled a new plan to help the UK come out of its current economical slump. And these plans are going to cause a lot of pain to the average dividend investor. The current recently increased rates on dividend taxes are 8.75%, 33.75% and 39.35%, all of course depending which wage bracket you currently fall under. But now these even recently increased rates are unsafe. The Chancellor's new ideas are being made to ensure the UK's economical stability and to boost trust in the government's commitment to budget austerity. But these new ideas and increased rates of tax have sparked a big worry amongst investors, especially dividend investors. Dividend income is taxable like all other forms of income and capital gains. However, there is a lot of variables to take into account that affect how much tax you will actually pay on your dividends. Things like your salary amounts, the type of dividend, and also the type of account in which your investment is actually held. But the amount of tax you owe on your dividends might actually change again, and not for the better. The dividend tax rate was actually expected to be reduced next year in April under the government's new guidance in accordance with Kwasi Kwarteng's suggestions on his mini budget in September the 23rd. But as the revolving door in Downing Street continues to rotate, the next Prime Minister and the next Chancellor has came in, and the new one, Hunt, has decided against this dividend tax reduction and instead flipped the other way and is now looking to increase taxes. Since most investors can typically protect their dividends in some way, shape or form via like an ISA account or some other tax advantageous account like a pension plan, the current changes that he's proposed as it stands are likely to only impact those of a higher net worth. So that said, if you are a dividend investor of any kind, I would definitely be looking right now to max out my ISA and my pensions to save on the upcoming tax changes. As it stands, everybody who's claiming less than £2,000 in dividends per year doesn't have to pay tax. That's your current allowance. But now it's seemingly becoming common knowledge that this £2,000 dividend tax allowance is actually going to fall down to £1,000 in tax allowance, or maybe even be scrapped at all. So if you're making more than £1,000 a year from dividends as it stands, be ready to start declaring and moreover pay tax on this income. Again, unless you can find a way of protecting it. At this point, it might seem like UK investors should just give up and go and buy something like a property or a digital picture of a monkey. Don't go and buy a picture of a monkey. But this potential increase in taxes and lowering of the allowances is still going to offer some intriguing opportunities. You just have to adapt and change your strategy and find a company with the right capital structure. It seems reasonable to draw to the conclusion that despite the reservations and the current exceptional circumstances the world is in, companies will shift to something called a stock buyback. And this is actually a win-win scenario for both corporations and its shareholders. And in my opinion, I actually prefer share buybacks than dividends anyway. This would offer an investor a much more tax-efficient way to see returns on their capital they've invested with a company. And I would be not surprised in any way if we see a massive shift from the UK away from its dividend investing, and newer investors will move more into buyback structures. When a company has accumulated all its cash and all its bills are paid, it has some options what to do with the leftover capital. This capital is typically called free cash flow, or if you look at a balance sheet, it might be under FCF. Now, what the company usually does with this free cash flow is it can pay off debt, it can pay you a dividend, which is what a lot of companies do right now. It can reinvest into a new project or a new sector, or it can buy back shares. And when a company uses its cash to buy back shares, it's essentially taking them off the market and burning them. And by lowering the number of shares outstanding on the market, the relative ownership, the percentage of a business you actually own as a shareholder, is going to increase, simply because there is fewer shares available and you still own the same amount of shares you initially bought. It's basically simple supply and demand. You own 10 shares, they used to be 20, now there's 15, so your 10 shares are actually a bigger percentage in terms of ownership. And this buyback of shares typically also pushes up the share price, as the earnings per share, or the EPS number, is going to be much better too. And the best part about why I prefer share buybacks to dividends anyway is because there is no tax to pay. You haven't received any extra income provided you haven't sold your initial shares. You've had nothing hit your account in terms of capital increases or in terms of a return. Buybacks are just unquestionably more tax efficient than having a dividend hit your account. And this is why many investing icons like Warren Buffett, Maresh Pabrai prefer share buybacks over dividends. And don't get me wrong, Warren Buffett and co actually do love dividends too. The buyback system simply seems to be more advantageous as an alternative for current investors in the UK. Given the current circumstances and the recent rise in taxes on dividend income, dividend investing in the UK is about to change dramatically. It's obvious that increased taxes would kill a lot of dividend investors off, making it harder for new investors to pull up and use the old tried and tested method of reinvesting your dividends over time, meaning it's much harder to hit financial freedom. It's estimated that more than 5 million individuals in the UK who hold dividend stocks are going to be impacted, or at least have an increase in taxes when these changes come into effect. And the government is hoping that these changes to the current capital structure and current system will ease off some of the economical pain the UK is currently in. But keep in mind that if the fundamental economical issues and depreciation of the Great British Pound continue, inflation continues, growth continues to stagnate, and the deficits across the board continue, and the lack of productivity and development, I doubt this will be the last time the government looks at putting investors in their sights in forms of increasing taxes. Whichever way you look at it, in the UK right now, it's the perfect time to start rethinking your current strategy, especially if you're solely looking at dividend investing income. The landscape looks like it's about to change forever. And if you're not prepared to adapt when these taxes and lowering of allowances come in, you just won't be maximizing your investing potential and your return potential. If you want to go ahead and see what stocks are buying back shares, you can go and look at shares outstanding. In a couple of weeks, even maybe by the time this video comes out, my software will be launching Stock MVP. And if you're lucky enough to find this video, you could be one of the founding members, where we offer an exclusive discount grandfathered in. The software itself has many features, and more features even coming, where you can quickly analyze a stock in seconds. It will offer you all the fundamentals about any stock you are looking at, and also offer you many features about analyst ratings, insider selling, Senate trading, and also many other aspects too. So if you're interested in that, check it out. There'll be a link for it down in the description. Again, it's called Stock MVP. There's 1,000 spots up for grabs at $100 for the year, and that would be grandfathered in. It's massively cheaper than any of the competitors. So again, if you're interested, go and check it out. If you've watched this far in the video, drop down in the comments the word dividend investing. It would greatly help me out. And in return, here is an absolutely horrifically bad dad joke. What did the buffalo say to his son when he left for work? Bye, son. That was horrific. See you later.